Hi, everybody. I'm going to go ahead and go through the chapter 14 slides with you. And then I will also go through the practice midterm in a separate video. And you can see those files here. You can also see present value table files that we're going to be utilizing to solve some of the homework problems later and help us work through a couple of the examples in our chapter 14 slides. So we are continuing our discussion of liabilities, and remember that we'll be dealing with liabilities for the next couple of chapters, and then we'll move into stockholders' equity as we wrap things up for the course and complete our discussion now of the financial statements. Income statement was, pretty much what you saw in 100B. Balance sheet you got started on, and we're finishing that up here in this discussion. You saw statement of cash flows in 100A a little bit. The asset side of the balance sheet, we finished that up here. Liabilities and stockholders' equity is sort of what we have left. So just before the midterm, we were looking at chapter 13. We were looking at the current liability side. And remember, we said that current liabilities are those that have a term of 1 year or less. We're going to see that when we look at the slides here in a minute, that anything that does not fit the definition of a current liability is automatically considered to be a long-term liability. The two that we're really going to be focusing on, though, here in this chapter are going to be notes payable long-term. And you're going to see that really there's no material difference other than the term between a short-term note payable and a long-term note payable. But I figure it was worthwhile for us to go ahead and take a look at that, and as more of a review of how to handle notes more than anything. Our main focus in this chapter is going to be bonds. Okay, we're going to go through that and get some practice with those. Okay, so first off, taking a look at the definition of a long-term liability. Again, it's anything that is not going to constitute a short-term. Okay, so it's sort of the catch-all for not short-term, then your long-term. Okay, we've got notes and bonds, as I mentioned. They're similar, and we're going to talk about those here in this chapter. Okay, so when we look at the situation here, and forgive me, guys, I know it's going to be a little annoying here as I have to keep clearing my throat. I'm not sure why that's happened. This last week, I've just have not been able to get rid of this annoying thing in my throat, so forgive me for having to clear so many times. I know that's annoying. So just taking a look at this example, Scandinavian Imports issues $100,000. It's a 3-year note. Okay, so it's going to be long-term at face value to Bigelow Corporation, and we have an interest rate of 10%, and Scandinavian would record the issuance of the note as follows. So we go ahead and we issue the note. Of course, we would debit cash when we receive that note, when we receive the cash on that note, and credit the note payable for the $10,000. We got this long-term liability, and then each year we would recognize the interest by simply debiting the interest expense and crediting the cash. In this case, we're having to make our interest payments each year, supposedly, and then, of course, we would pay back the note payable at the end of the 3 years. Okay, very, very simple stuff, almost introductory to accounting level consideration. Now, when we look here, we could have 0 interest-bearing notes. And when the interest rate is 0, that does not mean that the entity is not charging you interest. It simply means that they haven't stated a rate, but there will be a rate associated with that note, and we're going to have to sort of back into what that rate is, determining on how much money we're lent, and therefore that will determine the present value of that note. Okay, so in this case, we will receive the present value of whatever cash was to be received on this note. There will be a discount, and then we will amortize that discount into interest expense. And if that all sounds familiar to you, it should, because we really studied this in the context of a short-term obligation. Only difference now is the maturity of the note is going to go beyond the first year. Therefore, we're going to have to consider present value. And that's why I showed you those present value tables, because we're going to start to see how we have to use those to figure out interest rates associated with this, etc., to do the proper accounting for a note in which they haven't called out an interest rate. They call that zero interest bearing note. So you can see this illustration here. Turtle Cove Company issued a 3-year $10,000 zero interest bearing note to Jeremiah Company. The implicit rate that equated the total cash to be paid, $10,000 in maturity, to the present value of future cash flows, $7,721.80 cash proceeds at the date of issuance, was 9%. Okay, so let's just look here at the things we would know when we get this note. We would know that we're going to have to pay $10,000 when it matures. We would know that they simply did what? That they simply handed me $7,721.80 cash and then said, hey, at the end of this note, whatever it is, it's a 3-year note. At the end of this 3 years, you need to give me the full $10,000 back. There's the term 3 years right there. Okay. So what would we do here? Well, we would go ahead, and I like to do it this way because it just helps me to keep track of exactly what I'm doing. Okay. So what they're telling me is I'm going to have to pay $10,000. And that $10,000 was multiplied by some present value factor. Okay, and when I took that $10,000, its present value, they said they gave me $7,721.80, right? That's what they handed me. That's the same as telling me that's the present value of that $10,000 that you're going to have to pay me now in 3 years. Okay. In other words, if I walked up to you and I said, "Hey, buddy, give me $10,000 and I'll pay you back in 3 years. I'll pay you $10,000." You'd say, "Get out of here! Why would I do that? I'm not your pal. I don't know you. Okay, arm's length transaction. Okay, between two strangers. I'm not going to give you $10,000, let you hold it for 3 years and give me my $10,000 back. Maybe I'd." See a great deal in that 3 years that I won't be able to take advantage of because you're holding my $10,000. Get away from me before I call the cops, right? So then I turn around and I say, well, look, just give me $9,000 and I'll give you $10,000 back at the end of 3 years. Okay, so I'm going to make a little money off this deal. And we keep negotiating back and forth, and you say, finally, look, I'll give you $7,721.80, but you're going to have to give me $10,000 back at the end of 3 years. Time value of money says, okay, yeah, we can figure that out. There's a way to figure out what the interest rate is on that, etc. And so we can assign a present value factor to that deal. So we go ahead and we take this $7,721.80. We divide it by 10,000. And guys, you're saying, well, why are you dividing it 10,000? Because I'm doing the algebra here. Not in a very good spot, because I probably could have just gone ahead and wrote it somewhere else. I don't know why I wrote it up there. Okay, so present value factor, let's do it that way, therefore is going to be equal to $7,721.80. And I'm going to divide that by 10,000, right? I'm just doing the algebra on that. When I do that, that means that the present value factor, is right here, is equal to, just doing the math, 0.77218. Okay? Now, I want to see what interest rate lines up with 0.77218 for a 3-year note, and that's going to help me to figure out the interest rate on that. So I'm going to have to exit the slideshow for this, and I guess I'm stuck keeping this now. Let's just go ahead and take a look at the present value table. And these are the same ones that I showed you a minute ago in e-learning. And the two main ones we're going to use is present value of a dollar and present value of an ordinary annuity. Okay, present value of a dollar assumes that there will be just one lump sum payment that will come at the end of these terms. Present value of an annuity says, hey, there's going to be periodic payments. There's going to be $1,000 a year for the next 3 years or something like that. Now, this particular note, this zero interest note that we're looking at in the example, is a one-time payment. I pay the $10,000 at the end, and I know that the period is 3 years. So I'm going to take my ruler here, whatever, and I'm going to say, okay, 3 years, all right, that's the term. And I simply run my finger along until I find the present value factor that is closest to the one I just calculated. And this being a textbook example, guys, it lines up perfectly, okay? Most likely the way this would be being done is using the present value analysis in Excel, and Excel would spit out the correct interest rate to you. But since we're just trying to understand the theory here, I'm going to go ahead and use a table, and because it's a textbook, I think every single time the factor is going to turn out to a perfect interest rate. So now we know that the interest rate on this thing is what? Is 9%. Okay? So now that I know the interest rate, I'm pretty good to go ahead and finish this question up. Okay? So I'm just showing you that's how they came up with that 9% there. Okay? So you go ahead now and you come back to the slideshow. I don't have to keep backing in and out of it when I want my present value tables, but that's okay. So I got cash. I know that I have to pay $10,000 back. I know I got this cash. And sometimes students say to me, well, where did the discount come from? And the answer is, well, look, the discount is the difference between the present value of the cash that you got and the amount that you're ultimately going to have to pay back. So that's where that 227820 came from. That's the discount on this note. Okay. Okay, good. So we've got the cash that we received. We've got the discount. We've got the note payable here. Okay. So let's just go ahead now and take a quick look now at how we're going to calculate the interest each period. Okay. So let's just go ahead and take a look at it. So that difference is the discount that we'd be looking at here. And so often students will say to me, well, where does the discount come from? It's the difference between the present value and the face of the note. Now, just to quickly remember the balance sheet presentation, okay, so on my, of course, I'm just going to do the liability section for this. My note payable would be $10,000, okay. I would show the discount, which we just calculated, as the difference between the face of the note and the present value. Okay, I got this annoying 20 cents in here I got to deal with, 0.20, okay, and then they would have to make it 20 cents, so I have to stick that in, okay, and then you subtract that discount right on the face of the financial statement, and then you show the note payable, net note payable, and you will always show that at present value. Okay, so you're showing that at present value, but your presentation is the face minus the discount gives me the present value, which we call net note payable. Now that number is also the cash, of course, that I received, and that net note payable is an important number because what we're going to do is we're going to apply that interest rate, 9% that we found on the table, remember, and we'll use that to calculate our interest expense, and we'll use that to calculate the other side of the journal entry there, which is going to be the amortization of the discount. So when you look at this table on the next page, That's basically what they do for year one, since this money, I guess, was borrowed on January 1st. For year one, it's a full year. They borrowed it, say, in July, then it would only be 6 months interest, whatever, right? But since they borrowed this money July 1st, we do it for the full year, okay? We take the 9%. We debit interest expense, $694.96. We credit the discount on the note payable. Now remember, on our previous slide, we had debited the discount for this 2278, right? So if this is the discount, we'll tee up the discount here. And we had originally had in there, now I got to peek back, 227820. Okay, 227820. Well, here we're crediting it for $694.60, and of course, when we do that, 2278 minus 694, 2278.20 minus 694.60 gives us a new amount for the discount here. Now I'm just going to write the balance over here of $1583.60, right? Okay. So now, if I want to see what the carrying amount of that note is, I would take and let's just go ahead and calculate it by also presenting the balance sheet. Note payable is still the full $10,000, right? That's going to mature now. It'll be in 2 years. For $10,000, the discount we just calculated right there is $1,583.60. So the net note payable, also called the carrying value of the note, 10,000 minus 1583.60 gives us 8,416.40, the new carrying value of the note. Okay, now that's the carrying value for year two, and so I will then take that, just like I did for the first year, multiplying them times the carrying value for the first year. For the second year, I take the new carrying value, this 841676 times 0.09. That then is going to equal, I'll just draw a little arrow up here, of 75750. Okay, and I'll try not to get mad at my computer, although one student said they think it's funny when I get mad at the computer, so I'll try not to get mad at the computer. I will debit interest expense 75750 and credit the discount 75750. That's for year two, and when I do that, okay, and they gave me the number right there. I could have looked right there, and so on. And you just keep going like that until finally, by the end of that last year, the carrying value of the note is 10,000. You pay the 10,000. You debit the note payable. You credit the cash, and you pay back the 10,000. Okay. So even though it says zero interest note, there's no such thing as borrowing money without interest in the United States. Okay. Maybe you borrow money from your mom without interest in the United States, but if you were trying to do the formal accounting on that, you'd have to sit there and basically do something what they call interpolation of an interest rate to try to figure out what the appropriate interest rate on that is, assuming you were doing the proper accounting with your mom, which she probably the day you go to pay her back, she'll say, "Oh, that's okay, honey, you don't have to pay me back," right? Okay, all right. So let's go ahead Other than that, other than from your mom, your dad, you're not going to be borrowing money without interest. Okay. All right. So let's go ahead and let's take a look now at what happens if the interest note, the note is actually called out. We call that an interest-bearing note. Again, there's no such thing as zero interest, but some notes, they use the discount approach. Some notes are going to call the interest out. Now, when we look at this one, we're going to see that there's actually going to be two components here. There's going to be the calculation of interest expense based on the stated rate of interest, but they're going to tell you that you have an effective or market rate of interest that is different than the stated rate of interest on that note. And so we're going to still have to calculate a discount and amortize that discount as part of our calculations. Okay, so let's go ahead and take a look. And we have this Marie Company issued a cash a 10,000 3-year note bearing interest at 10% to Morgan Corp. The market rate of interest is 12%. Okay, so we've got a stated or interest rate that's called out on the note, but then we have a market rate that differs at 12%. That being the case, the lender is not going to lend me the full 10,000. They're going to lend me less than the 10,000, calculating the present value based on the market rate of interest, and I'm going to have to pay them the periodic interest payments. I guess it's maybe, I'm not sure if it's annual interest payments on this. It probably is. Okay, so they have to pay the interest annually on this. So we're going to calculate interest annually, and we're going to have to amortize and make an interest payment annually, and we're going to have to amortize a discount. So here, they just told me the present value. I didn't have to go to the table, is 9520. And so when the note gets issued, they're going to, of course, give me that much cash. There's a discount right off the gate of $480, and I'm going to have to pay them back the full $10,000. So I'm going to have to, there's two, interest costs that are going to be associated here. One, I'm going to have to pay them annual interest payments, and I'm going to have to pay them $480 more than I borrowed. I got to pay back the full $10,000. Even though I only received $9,520 of cash. Okay, so you take a look here, and I have this table here again, and similar table, and notice that they take the 9520, that's the carrying amount of the note, guys, face minus the discount. I'm not going to show you the balance sheet again. Same thing that we saw a minute ago for that other note, times 12% gives me the interest expense of 1142. Okay, however, I'm going to do what? I'm going to go ahead and I'm going to only have to pay this 1,000. So the difference between that 1,000 and the 1142, which is based on the market rate of interest applied to the carrying amount of the note, that difference is 142. And so I will go ahead and amortize the discount $142. Okay, so when I started out, the discount had, what was it, 480? Yeah, had 480. I had debited the discount. All right, bringing down the carrying amount of the note. I just credited it, 142. Okay, that leaves a balance in there after that first year. 480 minus 142. Gives me 338. Okay, so my year, at the end of year one, my balance sheet's going to look like what? Note payable is going to be still 10,000. My discount is now 338. Okay, 338 minus the 10,000 gives me 9662, right? Which is the new carrying amount of the note. Okay, year two, I go ahead and I multiply that times 12%. Gives me 1 159.44. Okay, give or take a few cents, whatever. That's my interest expense for year 2. Difference between that and the $1,000 that I'll pay out as cash is going to be the amortization, which I guess is this 159, right? Because I pay out $1,000 cash, is going to be the amortization of the discount in year 2, and so on. And eventually, the carrying amount of the note will equal the $10,000. I pay the $10,000 to make that last interest payment, and I'm done. Okay. All right. So if all of this sounds familiar to you, it should, because, hey, you know, we talked about this in the context of short-term notes as well, just the mathematics and the logic of the notes. Okay. Couple of things that they talk about in the next couple of slides here, guys, and I'm going to give you some time on your own to maybe look through those and talk through those a little bit more. They have the special situation where you issue the note, say, for property or goods, and you need to look to see which has a more readily determinable value. If it's the property that has a more readily determinable value, then you would go ahead and use the property as the basis for how much you're borrowing. So you're going to get some property and you're going to take a note back, then use the property or the goods as the value. If the property doesn't have a more readily determined value, then you're going to have to go and start to take a look at the note itself and basically have to come in and try to choose an appropriate interest rate depending on the creditworthiness of the borrower, etc. So once you do that, then you can go ahead and do the calculations along the lines of what we did on this particular example. Okay, so just taking a quick look at that one now. Okay, I'm just going to get out the slideshow for 1 second. Okay, and let's just take a look at this. All right, and so we have a situation where we're exchanging some different property, and we're going to sign a note for that, and we're trying to figure out, well, what's the proper interest rate that should be used here. So Wunderlich company, whatever company, issued a promissory note to Brown Interiors Company for actuarial services. So, architectural services. So I said property. It doesn't have to be property. It could also be service, right? And again, you're going to leverage the amount, or you're going to determine the amount of that note based on what has the more readily determined value. Is it the note, or is it the service or property, not just property that you're getting? The note has a face of $550,000, a due date of December 31st, 2025, and bears a stated interest rate of 2%. You look at that and you think, well, geez, in today's market, that sounds about right. Okay, they're going to assume here that that's too low. Okay, interest rates are so low right now that 2% might actually be a market rate. But in this case, they're trying to push it down low to make it seem realistic that it wouldn't be market rate, and we're going to have to do some things with this. Meanwhile, if you're watching this right now, and you know, post in the middle of the pandemic, that interest rate seems pretty low. But anyway, I mean, seems actually market. But anyway, the stated interest rate is 2% payable at the end of each year. Wunderlich cannot readily determine the fair value of the architectural services. Okay, now we know we're going to have to start searching for an appropriate interest rate on this, because the architectural services, we don't have a readily determined market for those, nor is the note readily marketable. In other words, it's not something that is traded on a day-to-day basis on exchange or something like that. So on the basis of Wunderlich's credit rating, the absence of collateral, the prime interest rate at the date, the prevailing interest rate, blah, 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 you start to now go through a process where you come up with what is a reasonable market rate for this note. And they, I think I said interpolate, they call that impute an interest rate of 8%. The correct term there is impute. Okay, so impute means sit there, and it doesn't mean guess, okay, but it means use the force more. It doesn't mean use the force. What's the word I'm looking for? It means be professional, pull in as much data as you can that's reliable, that's supportable as to how you come up with this interest rate, right? And so we take a look, and they come up with this 8%, okay? Now what they do is, based on that 8%, they're going to come up with this present value for the note, compare that to the carrying amount, and the difference is the discount, okay, as we've said already. Now, this note is a little bit different than the one we looked at earlier when we used the present value table, because there's two cash flows coming out of this. There's the principal that's going to have to be paid back at the end of the note, but there's also those periodic interest payments that were based on the 2%. So when you take a look, they have what? They have this $550,000 that's going to come back, and they're going to want to pick up the present value of that. And they have this $11,000, and I don't know about you, but I don't trust anybody when it comes to calculations, so I always make those myself. The $11,000 came from this $550,000. Times 0.11 is where, not 0.11, sorry guys, where am I getting 0.11? Times, just 11,000, times 0.02. That was the interest rate on that note, was this 0.02, right? Okay, that's where that 11,000 comes from. Okay, so that's going to be the periodic interest payments, right? Now, what we need to do is we need to discount those at the 8% rate, and it was a 5-year note. So, once again, I have to go through this process of getting out a slideshow, and it's going to make me keep these. And then I'm going to go ahead and take a look at my present value tables. And it was what? For the principal, $550,000, we imputed an interest rate on that of 8%. So I know I'm going to be here, and it was 5 years. So here's my 5 years, 8%. 5 years, 8% gives me 0.68058. 0.68058. Keep saying that to yourself while I find my slideshow. Okay, and that was what? 0.68058. Good. Present value of that is $374,319. That's the principal. It was a one-time payment. I was on the present value of the dollar table. Okay, but then I've got these what? These interest payments. There's going to be 5 of them over the next 5 years. That's an annuity. A stream of payments is an annuity. So I can't use this present value of a dollar table for this. I have to go to a different table. I have to go to the present value of the annuity table now. Okay, so now it's 5 years. It's what? 8%, I think the problem said. 5 years, 8% gives me a present value of annuity factor of 3.99721. I know that the numbers are more than 1 on this annuity table because it's more than 1 payment. The only time the numbers are not more than 1 on this table is for the 1 payment, and I think that they shouldn't even put the 1 payment line on an annuity table, because annuity by definition means more than 1 payment. So there's no difference between the present value of a dollar for 1 period, the numbers on that table, versus the present value of the annuity table. Just compare them for 1 payment. So I don't know why we need the 1 row on the annuity table, but okay, they didn't want to, just keep the number 1 off of there, so they went ahead and put it there. But all the rest of the numbers, since it's more than 1 payment, are more than 1. And so 3.99721, go back to my presentation here, 3.99721. Yeah, that's the number. Okay, so now I use that number to get the present value of the interest payments. I add those two together, and so the present value of this note, which is going to yield $550,000 when it matures, It's going to yield $11,000 a year interest payment. The present value of that is at the 12% interest rate that they gave us in this problem, or 8% on this one. Interest rate that they gave us in this problem is $418,000. 239. Difference between the face and the present value is, as we've said a couple times now, the discount. Okay? Okay, good. So when they record this note, notice they debit the building, because remember, these were architectural fees. Architectural fees, remember from our earlier discussion, are part of the building cost, right? So we go ahead, debit that, credit the note payable, and the difference is the discount. Okay? And then we would simply go ahead and amortize that. And when we amortize that, we're going to basically do the same thing we saw for that other note on our previous example now, where we're going to go ahead and do what? We're going to take the carrying amount times the interest rate, and this is our imputed rate, 8%, that's $33,459, right? The difference between that and the actual cash we'll pay is the amount that will get amortized on that discount. Okay, so we will go ahead and debit our interest expense, which is the carrying amount of the note times the interest rate. We'll obviously have to credit our cash for the $11,000. That's based on that 2% that we have to pay out every year for the next 5 years on this note. And that difference, right here, is going to be the amortization of the discount, and we'll just continue on like that year to year. Okay. At this point, we're no different from that note that we looked at earlier that we were having to pay cash out, etc., as we amortize the discount. Okay, alrighty, so that's a good start for us. Let's go ahead and we will take a quick break. You can go ahead and pause, and I will pause too, and we will come back and pick up our discussion of bonds. Okay. Okay, so let's go ahead now and turn our attention to bonds. Okay, and that's going to be the other major area that we're going to focus on for chapter 14. And we have this quick slide here, bond basics. What we're talking about really in this class, in this chapter, are unsecured bonds. Okay, they're not secured by any particular collateral, that sort of thing. We're mostly going to talk about, in fact, entirely going to talk about term bonds. The term of the bond is how long it'll be outstanding. 5 years, 10 years, whatever. Okay. We're going to be talking about, we're not going to be talking about either of these categories here. There are things called convertible bonds. Convertible bonds can be converted to stock. You give me back the bond, I issue you the stock. Callable bonds means that the issuer of the bond can call the bond at any time that they want to, with certain price parameters, etc. Okay, and we'll talk a little bit about how, if a bond is called before maturity, calculating the gain or loss on that. Okay, early extinguishment of debt. All right. Now, just to make sure that we are clear what happens with bonds. Okay, so we're the company, right? We have a project, and the project needs an infusion of capital, of money, okay? So what happens? We could sit there and say, well, we're going to go to a bank, okay, and try to get that money, right? Do banks have money, right? Try to get the money from the bank. But the bank looks at that and says, look, company, that project is just way too big for our bank. We cannot finance something that large, and it gets difficult to track capital from just, say, 1 or 2 lenders. So we say, well, instead of going to the bank here, that's why I crossed out the bank, what we're going to do is we're going to go to the public, to the people. Bunch of people. Okay, I'm going to only put 4 here, but that's going to represent the whole investing public out there. And we're going to say, look, we need money for this project, and we probably won't necessarily call out the nature of the project that the bonds are for, although we could. But regardless, we're saying we're trying to raise capital. Okay, so they give us the money in exchange. Okay, we could give them stock, but that's not the subject of this chapter. Okay, in exchange for their money, we give them a bond. And with this bond, okay, and I'm just going to put the bond now more over here just so I have more room. Okay, with this bond will come the promise to pay back the principal and pay back the interest. And pay interest on that, okay? So we have to pay back the principal. We have to pay the interest on that. In other words, there's going to be cash flows that'll come out of this bond back to the investor. The interest payments on bonds, it's typically every 6 months. We call that semi-annual. We'll pay you an interest payment every 6 months. And of course, at the end of the term of the bond, 5, 10 years, whatever, we'll pay you back the principal. Well, since this is cash flows, and those cash flows are coming what? In the future, what these people are willing to pay for this bond is going to be predicated on present value. So, what we're going to be doing now for the back half of this chapter as we look at bonds is understanding, well, what should an investor pay? And we're doing the accounting, of course, for the company here, okay, the company that's issuing the bond. We're talking about the liability. So what should the company receive for that bond? Okay, what should the investor pay for that bond? And then how will we calculate the interest expense associated with that bond? And then, as I said, if we call that bond early, we'll be talking about calculation of gain or loss if the bond is called before maturity. All right? Okay, that's all we're looking at here. So let's just go ahead and let's just take a look and let's do a little recollection here of something we probably learned in introductory as to how you determine whether a bond will be issued at a discount or at a premium. Okay, now discount means that the bond will be issued for less than face. So if the face of the bond is, say, 100,000, okay, let's make it $1 million. The face of the bond is, say, $1 million. Okay, we're going to issue that for $987,390, less than the face, right? If the bond issues at a premium, okay, then we're going to issue that bond for more than face, $1,081,095. Okay, just throwing some numbers out there, but you can see the bond issues for, if the bond is a face, $1 million. If it issues for a premium, if it issues at a premium, that's more than face. If it issues at a discount, that's less than face. Now, what determines whether a bond will issue at face, less than face, or more than face? Well, bond issues at face if the coupon rate of interest, the stated rate of interest, these are all synonymous terms, coupon, stated, contractual, let me write those all in, stated rate of interest. Sometimes you see it called the coupon rate. Contractual rate of interest is equal to the market rate the bond will issue at face. Now, this really rarely happens. Okay, look, you're getting ready to do this bond issue and you're trying to target the coupon stated rate of interest, the contractual rate to whatever the market rates are, and market rates have an annoying habit of not staying still. They change every day, in other words. So what happens? It is very difficult to hit that exactly when you finally issue that bond. So the chances that a bond are going to issue at face, although you see it in textbooks, are not very likely. Okay, so the bond issues at face when the market rate of interest equals the stated rate of interest, the contractual coupon rate of interest, synonymous terms. That almost never happens. Generally, the bond will issue at the contractual rate, I should say, will be more than the market rate or less than the market rate. Okay. Now, in this example, let's deal with the discount bond first. Market is paying 12% for bonds of this nature. Okay. And what happens? Our bond has a contract, a coupon rate that says, hey, we're only going to pay 10%. Does anyone want our bond? No, because they're saying, look, there's similar debt out there in the market that's paying 12%. You can't expect to only pay 10% to us, so no, we don't want your bond. Well, what happens, just using the law of supply and demand, when there's a better deal out there, that says you have to lower the price of your product, in this case, the bond. So we lower the price. We say, well, wait. Okay, since you're saying that our bond only pays 10 and you want a bond that pays 12, we'll discount the bond. We will take less cash when you purchase the bond than the face, and then we'll pay you back at face, thus bringing the rate of return back to what the market is requiring at that time, the 12% in this example. So when the market rate is more than the stated coupon contractual rate, bond has to sell at a discount so that ultimately the purchaser of the bond will receive the market rate of interest. Now, conversely, like I said, rarely their bond will issue at face. Let's go to the premium situation. Now what happens? Well, now we're sitting here and we're saying, okay, my bond pays 10%. The market is only asking 8%. Well, now everybody loves my bond, don't they? Everybody's stepping up and saying, wow, what a bond. It pays 10% when the market's only paying 8%. And I say, hang on there, Tiger. I'm not going to pay you 10% when the market is only asking 8%. What you have to do is pay more than face, this 1,081,000, 095, whatever. You're going to have to pay me more than the face, and when the bond matures, I will only give you back the $1 million. That's catching me up now for all that time that I paid out a contractual interest rate of 10%, when in fact the market was only requiring an 8% return at that time. Okay, so again, just think through this, because I may ask you a couple questions like this. You'll see in the practice midterm, and on your actual midterm, I'm going to ask you a couple questions like this. If the market rate of interest is more than the contractual stated coupon rate of interest, okay, 12% versus 10%, bond issues at a premium, right? Bond issues at a discount, Bond issues at a discount, not a premium, at a discount. If what? If the contractual stated coupon rate of the bond is more than the market rate, so bond is paying 10, market's only asking 8, then what? Then the bond issues at more than face, bond issues for a premium. Okay, good. That's a good review of that. I'm sure you had looked at that at one point in time before. So let's just go ahead and let's take a look at an example. And this bond here issues at par value. I'm not going to spend time with that because, again, bonds rarely issue at face. Issuing at par value, issue at face. That doesn't happen much. Let's turn our attention right here, okay? And let's start out with the situation with the discount bond, okay? So we got this example, and what we're going to know, if it's a discount bond, it's going to issue at less than face. The face of the bond here is $1 million. Okay, the coupon rate is 10%. Okay, don't worry about the market rate here yet. The coupon rate is 10%. The term of the bond is 5 years. Semi-annual means we have 2 interest payments per year, and those 2 interest payments, thank you, are June 30th and December 31st. Now you look at this and notice I told you over there that the coupon rate of the bond is 10%. That will not change. Think of it, although they don't really print bonds anymore, bonds really only exist in a book entry form on a computer server somewhere. Okay, but just picture for understanding's sake, the 10% is printed on the face of the bond, is chiseled into the face of the bond. That will not change. What fluctuates is what? is the market rate of interest, okay? And in this example, they tell me the yield or market rate, synonymous terms, is 12%. So what's happening? We've got a situation where the market rate is more than the coupon stated contractual rate. This bond will issue at a discount, okay? So we know it's going to be for less than face, but how much less than face? What would be the actual price? So this is where we start to get back into our present value accounting. And so we're going to sit here and look at what? Well, we're going to look and we're going to see that the bond will pay back on face $1 million. We know that. It's going to pay back the face of $1 million. So we need the present value of that $1 million. So what we do is we sit here and we take this calculation and we say 0.55839 times 1 million is going to give us the present value of the face amount, okay? So what happens? 12%, we take the market rate of interest. Since it's a semi-annual bond, we divide that by 2. That gives me what? 6%. And since it's a 5-year bond, but it's paying 2 interest payments, we're going to have what? 10 periods. You count 10 periods because it pays interest semi-annually, okay? So just taking a quick look back now. I guess I'll have to keep that, okay? And going to my present value table, and here I'm going to, I guess I could have stayed in the slideshow for this one. I don't have to go to the actual table, so let me go back and look at my table here. 12%, okay, that's that. I'm on to the next slide, guys, from here, okay? 12%, okay, divided by 2 is 6%. 5 years times 2 semi-annual periods is 10 periods. So I come to the present value of the dollar table here because that principal payment is just paid back once at the end of the 5 years, at the end of that 10th semi-annual period. So I come to 10 periods, 6%, 0.55839. That's where they got that factor, 0.55839. You multiply the face times that. I've got the present value of the face, okay? But that's one of the 2 cash flows. The other cash flow is going to be those semi-annual interest payments. Now, to calculate the amount of the interest payment, you have to take that face amount of the bond times the coupon stated rate, coupon stated contractual rate, we've called it, right, which was 10%, okay? But then you take that 10% and you do what? You divide it by 2. When they quote the rate at 10%, that's the annual rate. To come up with the semi-annual rate, we have to divide it by 2. 10% divided by 2 is 5% times $1 million. Means that this bond will pay out $50,000 every 6 months for the next 5 years. Well, that's 10 semi-annual periods. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then when I make that last semi-annual interest payment, I also pay back the principal. We've already figured out the present value of the principal. So now we just have to figure out the present value of these semi-annual $50,000 interest payments that will stay the same regardless of what happens with the market rate. So we got the $50,000, but to find the correct factor to discount, we don't pick up the coupon rate of interest. We always discount at what? At the market rate of interest. So we're going to pick up the 10 periods at, and market rate is the 12% divided by 2 at 6%. So now we go back to our table, and now we have to go to the annuity table because this is now a stream of payments. It's not a single payment anymore. So now, like it was with the principal, so now we go and we take a look over here again, 6%, 10 periods, 6%, 10 periods, 0.736009. Go back to our calculation. Yeah, 0.736009. We multiply that by the 50,000. Now we've got the present value of the two of the two cash flows here, the interest and the principal. We add those together. That gives me $926,395. Yep, mathematics of finance is correct. The bond issues at less than face, and now we've mechanically figured out, we've seen the process of figuring out the correct issue price for that bond. So the bondholders purchase the bonds. The company ends up with $926,395 of cash. We have what? We have bond payable gets credited for the face amount. And then we have to make this journal entry balance. The difference is $73,605. That's the discount. Now, when the bond pays back, it's going to pay back the full $1 million. And so I'm going to have to pay out an extra $73,605. That's compensating my bondholders for all those years that they only received a what? 10% return when the market was requiring what? A 12% return. They get caught up at the end of that bond. Okay? Don't worry about investor side, guys. We're not going to cover that here. We covered, investments and marketable securities and whatnot in another chapter, in another class, frankly. So we don't have to worry about that here. Okay? Okay, good. Now you come over and let's just take a look at what happens if it is a premium bond. Okay? Actually, yeah. Let's just take a look and see what happens if it's a premium bond. Okay, and then we'll come back and look at how we calculate carrying value of the bond. So just right now, key thing to understand, less than face, the difference between the face and the price that we calculated using present value. Understand the mechanics on that. Difference is discount. Okay, all right, let's look at premium. Okay, now it's sort of the heading kind of here is like a movie where the title is The Hero Dies. Okay, we know this is going to be issued at a premium. Okay, but notice something about our bond here. Okay, it is a what? Same bond. Same bond. 5-year term. Semi-annual. 2 interest payments. June 30th and December 31st. 10%. The bond didn't change. The bond stays the same. What changed here is what? The market rate of interest now is what? Is now 8%. Okay? So now, when I make my calculations for present value, I don't use 10%, just like I didn't use 10% before. Market rate of interest was 12%. We used 12% before. Here now, since the market rate of interest is 8%, I take that 8%, I divide it by 2. That gives me 4%. And it is 4% for how many periods? For 10 periods. Okay, so now you come down and you see how they did that. We have what? We have the principal, 10 periods, 4%. They give me that factor. I'm going to multiply the $1 million face by that just to give us a little more practice with the table. Why not? Okay, so we've got what? 4%, 10 periods, 0.67556. Was that the number they gave us here? Okay, 0.67556. Yep, okay, they picked up the right factor, multiply that out. There's the present value of the principal. Now I just got to sit here and try to figure out the present value of the interest. Very important here, guys. Okay, very important here. And all this switching a pen is annoying. So, okay, take a look. They got to do a better job of this. I don't know why. Why can't they just give me a palette of pens in things like they do in Word. They do it in Word. Why can't they do it in PowerPoint, where I'm probably more likely to be marking something up? Anyway, okay, so what happens? Well, we take the million, right? That's the face of the bond. We multiply it by the 10% divided by 2, right? That gives us 50,000. That's the contractual rate of interest. Remember, we're discounting the cash flows that are come off of this bond, and the bond is contractually obligated to pay those 50,000s, right? And so again, it's 10 of them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and then that last principal payment and that last interest payment come out. The principal payment and the last interest payment come out on the same day, right? And so we have these 10 50,000s, right? The 50,000 won't change. That's a contract to pay 50,000 every 6 months for 5 years. That doesn't change. The market rate's going to be doing all kinds of things over this 5, 10 semi-annual periods, 5-year period. The contract rate is going to stay the same. Okay, and so this is why people invest in these bonds. They're using them as a vehicle for producing some income off of the $1 million they had to lend us, whatever, right? Okay, so we have this 50,000, okay, and we calculate the present value, and let's go back to the tables one more time just for kicks. Okay, and so I guess my table is this way. Present value of the ordinary annuity, 10 periods. Now we've got what, 4%, 0.811090. Good, that's that factor. Let's see, I gotta go forward to find that. Okay, there it is. I multiply that out. That gives me the present value now of the interest. You add those together, and no shock that that is more than face, because the bond issued a premium. Why did the bond issue a premium? Because the coupon contract stated rate of interest was more than the market rate of interest. So I go ahead and I debit the cash. I credit the bond payable, always at the face, million. I need a credit to make this journal entry balance. That difference is the premium. Okay? Okay, so basically mirror image of the discount, where the discount, the bond was less than face. It was less than face because the market rate was more than the contract coupon stated rate, right? Okay, for a premium bond, what happens? Bond issues at more than face. Why does it issue at more than face? Because we had a situation now where the contract coupon stated rate was more than the market rate of interest, which was 8% in this example. Okay, and then you saw the mechanics of how to calculate that more than less than face scenario. All right, okay, good. Now, what happens? We're going to amortize the discount, and then we're going to amortize the premium. And we're going to see that we have two methods available to us under US GAAP. The two methods available to us under US GAAP, we'll look first at straight line, and then the effective interest. Now, straight line, they tell us we can use if it's not materially different from effective interest, which is a little annoying because you're saying to me I have to figure out what the calculations would be of the amortization of discount or premium under effective and straight line, and then see if there's a material difference. By the time I get done doing that, why wouldn't I just use the effective interest method? So most of the time that we'll spend will be dealing with the effective interest, but I'm going to review with you quickly the straight line. And I guess you could look at a bond over its history and say, okay, the straight line is going to be not materially different from effective, so we'll just use straight line because it's easier, I guess. Okay, but I would think, effective is probably more likely, and so we'll spend more of our time with that when we look at some of the examples of questions and stuff later. Okay, but if we use straight line, okay, we would take the $73,605. Remember, that was the difference between the face of the bond and the issue price that we calculated using present value. That's that $926,395. That difference is $73,605, like we saw. Under straight line, since the bond is going to be amortized over 10 semi-annual periods, 5-year bond, 2 interest payments, 10 semi-annual periods, that gives me $7,360.50 per 6 months, every 6 months, that we will amortize this bond. Okay, so what do? We come over here and we have what? We have the $926,395, right? That was the carrying amount of the bond when we first issued it. We amortize the discount. Okay, we know that we're going to pay $50,000 of interest every 6 months, and then we're going to have to pay what? $73,605 more than we borrowed. Remember, we only got $926,395 cash on this, right? When we issued the bond, that's the amount of cash we got when we issued it. So we're really paying more than just $50,000 of interest, because we have to cough up $73,605 more at the end, because we have to pay back on face $1 million. So the way we account for this is we add the amortization of the discount to that $50,000, and that becomes our interest expense. And under straight line, we'll take that interest expense every 6 months. Okay, so you can see our first semi-annual interest payment at June 30th. Remember, we pay interest on June 30th and December 31st is $57,360.50. We're going to, that's what's calculated right there. We're going to have to credit cash $50,000, and then we will credit the discount $7,360.50. Since we debited the discount when we first issued the bond, that's going to bring the amount of discount down, right? Okay, so let's just go ahead and see how the amortization of the discount is going to affect our interest expense, and then how it's going to affect the carrying value of the bond. Okay, so a couple things. First of all, interest expense, no-brainer. The amortization of the discount gets added to the cash interest. That's going to bring what? That's going to bring the interest expense. It's going to be more than the actual cash. So when you have a discount bond, your what? Your interest expense is going to be more than the actual cash you pay, because you're amortizing that discount each period, because at the end of the bond, you are going to pay $73,605 more. Okay. Now, let's just go ahead and take a look, though, at a couple of computations, and I'm going to come back to those other ones in a second. But what happened? Okay, we issued the bond, that journal entry, we debited the cash for the $926,395. This is bond payable. We credited the bond payable for the full $1 million. All right, okay, it's $1 million, and then we sat here and we debited the discount for $73,605. Right? With me so far? Okay. Then, when the first interest payment was made, we went ahead and we made this journal entry right here. We debited the interest expense, adding the amortization of the discount to the $50,000, credited cash, and we credited the discount $7,360.50. Okay, so when you do that, $7,360.50, right? Was that the number that we credited? Just to double check that. Yeah, wrong way. Just to double check that. Yeah, $7,360.50. Okay, so I take now this $73,605, I subtract $7,360.50. That gives me now a balance in the discount account of $66,244.50. Okay, so if I were to prepare my balance sheet now at 6/30, and I'm just worrying about the liability, The bond payable, just look at the T accounts, guys. Bond payable is what? $1 million. The what? Balance in the discount now. Okay, just preparing the liability section, just looking at the T accounts here, looking at my ledger accounts, is what? $66,244.50. So the carrying value sometimes it's called book value. Carrying value, book value, etc. are synonymous. Okay, is going to be, I'm calculating $933,755.50. So when you look at that carrying value at 630 versus the carrying value at 1/1, okay, this is all year one. The carrying value of the bond at year one, January, when I, in this example, issued this bond, right, at 1/1, okay, was, if I picked up the discount at that time, was $73,605. Okay, that was that 900 and what was that? Not a stupid number. It's the amount of cash I got. $926,395. Right? So I ask you, did the carrying value go up or down? And what, between January and June, as I amortized the discount, the carrying value came up. And of course it came up because what? I subtract the discount from the face. If I made the discount less as I amortized it, the carrying value of the bond came up, okay? And so that's basically what happened here. It came up. So when you amortize a discount, the interest expense is more than the cash interest, and the carrying value of the bond goes up. So everything comes up when you amortize the discount, okay? And that would continue on now through the life of this bond. Now notice what, that carrying value keeps coming up 6 months after 6 months until finally it is listed at face at the end of the bond, and I go ahead and pay back the full $1 million. Okay, good. Now you come over and you look at the amortization of the premium now. And when we come to the amortization of the premium, remember this bond list issued for more than face, so we got this extra $81,105, and we're only going to have to pay back the $1 million. Okay, that's because this bond was paying 10% when the market was only requiring 8% all that time. So I do what? I take this $81,105, I divide that by 10, that gives me $8,110.50 that I'm going to amortize off this premium every 6 months. 5 years times 2, 10 semi-annual interest periods. Okay, so I go ahead and I do what? I take my 8,110 and I do what? I subtract it now from the 50,000. 50,000, the $1 million times 10% divided by 2, the 50,000, that's locked in. That's not changing. That 50,000 for this bond will stay the same. What is going to change is the market rate of interest. And again, these are mutually exclusive examples. In one example, I issued the bond for 12%. Now I'm issuing the bond at 8%. But market rates do what they're going to do when you go to issue. That coupon rate stays the same. Contract rate, that stated rate stays the same. And so I subtract that premium amortization off the 50,000 because what's happening? I'm going to get to keep an extra $81,105 after the bond matures. In fact, I already have that money and I'm going to get to keep that. So my interest isn't really $50,000. It's what? it's less than $50,000, and I count for that every 6 months by amortizing that over the 10-month semi-annual interest payments. Okay, so if that's the case, then when I make that first interest payment, I debit my interest expense, not $50,000, not $50,000. My interest expense is less than $50,000 because I get to keep that extra $81,105, the premium. I have to credit the cash $50 because I'm going to pay him $50,000 cash, and now I go ahead and I debit premium for the $8,110. So what does premium amortization do to my interest expense? Well, it makes it less than cash, right? The cash was 50, the interest expense is this 41, whatever, okay? And let's see what it does to carrying value. So let's just go back to our little computation page, and for the premium here, I guess I'll use the Caribbean blue, okay? And I better use a darker blue. That's maybe not that easy for you to see. I'll use this darker one. The lighter blue had some appeal to it, but we want to see it, okay? So again, I would have credited bond payable $1 million. So I'm not going to redo bond payable, but I'm going to go ahead now and set up my premium over here. And I credited it for $81,105. Okay, so that was the balance there. If I prepare my balance sheet at year one, okay, let's do that first. Bond payable, just doing the liability part, is $1 million. Premium is, just picking that up, that's at 1/1. I'll just write that there. Picking up the premium, that's $81,105, right? That brings, and I add the premium. They're both credits, right? The bond payable is a credit, the premium is a credit. So now I have what? Carrying value. Carrying value bond payable is $1,081,105. Okay, all right, good. Now what happens? Now I go ahead and I amortize that premium, right? I debit my interest expense, $41,000. I have to credit the cash the full $50, $41,000 some change, whatever that was. And I debit the premium, and let me just go back and see if I can remember that stupid number, $8,110.50. Okay, and when I do that, now my balance here at what? At 6/30 year one, okay? 6/30 comes to $81,105 minus $8,110.50. I'm calculating here at 6/30, the balance is $72,994.50. Okay, $72,994.50. All right. So now, when I calculate the carrying value of the bond at 6/30, year one, bond payable, still sitting there at $1 million. Just picking up the T accounts. Sorry guys, I've got some things going on here if you're hearing all that racket in the back. I don't know when they decided that they should start showing up at the middle of the afternoon on me, but it is what it is. Okay, and so now I pick up the premium. Premium is $72,000. All right, just picking that up number there, $994.50. Remember, I add the premium. So when I do carrying value, that's $1,072,994.50. The carrying value did what? Did it go up or down? Carrying value comes down. And it should come down because what? Because I've amortized the premium. I made the premium less. Premium is added to the face for a premium bond. And so since the premium is less, the carrying amount is less. Okay, so for my premium bond, what happens? The interest is less than the cash interest, and the carrying value from period to period as I amortize the premium is less. So things are going downward, right? As opposed to with the discount, the carrying value came up and the interest was more than the cash interest. Okay? Okay, good, guys. We're going to take a little break here so that we can let some of that noise go away. And we'll pick up this here in a little while, okay? All right, great. Thanks. Okay, good. So we now have seen those computations. So I want to just take over and take a look at the next slide. And this is good to help us just remember how the unamortized premium or unamortized discount, it can't be both. Of course, it has to be one or the other, right? You can't have both a premium and a discount, okay? And so you have the face of the bond, whatever that is, $1 million, and then you add any unamortized premium at the date that you're preparing your balance sheet to calculate carrying value for a premium bond. For a discount bond, it's going to be face minus the unamortized discount. And that's how you'll determine carrying value at any point in time. And then, of course, just remember, as we amortize the discount, carrying value goes up. As we amortize the premium, carrying value comes down from above face to below face for the premium, from above face down to face. For the discount, from less than face to the face amount. Okay? And then, of course, the effect on interest expense. Remember, premium amortization will increase. Premium amortization will decrease the interest below the cash. Discount amortization will increase the interest expense above the cash amount. Okay? All right, good. So now what we're going to do is turn our attention, that was straight line. Now we're going to go ahead and turn our attention to the effective interest method for calculating, our interest expense and our amortization of our premium or discount, okay? So basically, when you're dealing with the effective interest method, you're going to take whatever the carrying amount is of the bond, and you're going to multiply that by the market rate of interest. So we'll figure out our carrying amount of the bond at the start of each, and if it's a semi-annual bond, it'd be at the start of each 6-month period. If it was a annual payment of bond, it'd be at the start of the year. But whatever the period is that we're going to be amortizing that, you'll take the beginning balance of that at the beginning of that period, and you'll multiply that by the market rate of interest, 12%, 8%, right? Then you'll compare whatever that yields. You will then compare that to the cash interest that's paid, and the cash interest doesn't change. It's always predicated on the stated contract coupon rate of that bond. Say that $50,000, that won't change. So you're going to compare the interest expense that you calculated by multiplying the beginning carrying value for that period of the bond by the market rate of interest. That yields you the interest expense. The difference between that and the cash interest, in our example, the $50,000, is going to give you the amortization of the premium or discount. Once that amortization, premium, or discount comes, and it works exactly the same then for the straight line, that gives you the new carrying value. If it's a discount bond, carrying value comes up. Premium bond, carrying value goes down. Multiply that new carrying value by the market rate of interest, and that's going to give you your interest expense, compare that to the cash, which won't change every 6 months, 50,000, 50,000, whatever it is for that particular bond. That difference then is going to be the amortization for that next period. Okay, so hang on if that seems a little bit confusing, but let's just go ahead and take a look. Our interest expense, okay, always carrying amount of the bond times the market rate of interest. In our little example, 12%, 8%. Okay, when you figure out the amortization of either the premium or discount, that's the difference between the interest expense that you just had calculated up there. Okay, that's the difference between that interest expense, and this pen drives me bananas. The difference between that interest expense that you calculated up there and whatever the interest payment is. Again, it's not the same for every bond, of course, but for the example that we've been using, that interest payment is going to be that $50,000. It's $50,000 regardless of whether it's a premium bond or a discount bond, right? But the amortization is going to be the difference between that $50,000, whatever the interest expense is, that we will always calculate by taking the carrying amount of the bond and then multiplying that by the market rate of interest. The only reason they put the interest expense on the other side in this graphic here is they wanted the number to come out positive. So just think of it, it is the difference between the cash interest, right, which is the face of the bond, times the coupon rate, and the interest expense, which is the carrying amount of the bond times the market rate of interest. Coupon, contract rate, those are all, of course, as we've said several times now, synonymous terms. All right? Okay, so picture's worth a million words, right? So let's just go ahead and look here. I don't know about a million words. That'd be an awful lot of words that a picture would have to do better than, okay? But, well, you know what I mean. Let's look at the example, okay? So we've got the premium bond. We're going to start with the premium this time, right? $1,000 million bond, 1,089,109, issued January 1st, year one, 8%, and of course we know that that bond is a 10% bond. So right out of the gate, we know, hey, those interest payments are $50,000 no matter what happens, right? That cash is going to be paid out. That's why they call it the contract rate. You will pay that $50,000, the coupon rate, whatever, synonymous terms. You will pay that $50,000, okay? Then what happens? Then to figure out the interest expense, okay, seems appropriate to change the color here. We're going to go ahead and take the carrying amount. Well, when you first issue the bond, it's what? It was the $1 million face plus the $81,109 of premium, right, as soon as you issue it. So for that first 6-month period, January 1st to June 30th, we have a carrying amount of $1,081,109. We multiply that by the 4%. Okay, let's go ahead and make sure we realize that we're multiplying that there. Okay, so we go ahead and we times that. Okay, that equals $43,244. We compare that to what? To the $50,000. That's going to always be the same. That gives me the amortization of the premium. Okay, and then it's the same thing that we did before, the amortization of the premium, as we did for straight line. The amortization of the premium reduces the premium, and since the premium is added to the carrying value, if you reduce the premium, the carrying value for that next 6 months of that bond is going to come down. So now the carrying value is $1,074,000, right? When you first issued the bond, you debited the cash, $1,081,109. You credited the premium, $81,109. You credited the bond payable, $1 million. Then when you go ahead and you make your interest payment, of course, you're going to credit cash for $50,000, debit interest expense for $43,244, and you're going to go ahead and debit the premium, bringing it down by $6,756. So the mechanics of the journal entry work exactly the same, whether it's straight line or whether it is the effective interest method. And then you go ahead and you take that 107.7453, the new carrying amount, times the 4% equals the interest for the next 6 months. Compare that to the $50,000. That won't change. There's my amortization for the next 6 months. You subtract that from the previous carrying value. gives you the new carrying value, and so on. Okay, so notice, just like we saw in straight line, the carrying value of the bond keeps coming down period by period, and you can see the mechanics here, but it makes sense if you just stop and think about it for a second. At maturity, I'm going to only have to pay the $1 million. So it makes sense that as I get closer to the date of the maturity, the carrying value comes down. The only difference between this and straight line is now we're using the mathematics of finance to systematically amortize that premium in this case, unlike the straight line, which just hacked it up and said, okay, it doesn't matter, that we're getting closer to the maturity date, we're going to amortize it the same every single period. US GAAP says, you should use the effective interest method unless you can demonstrate to your auditors that the straight line is not materially different from the effective. Okay, so I reckon if you had a bond with a relatively low interest rate, probably the difference would not be that material. Okay, but in most cases, it's probably material enough that you should probably go ahead and use the effective. Or if the face of the bond was not that much, interest rate is relatively low, I reckon there wouldn't be that big of a difference because you're dealing with overall smaller numbers, right? Okay, but it really depends on the size of the company, etc. So in this class, I might give you one question on your exam on straight line just to make sure you're on board with that. Okay, in case at some point in time if you were taking a CPA exam or something, they asked you about straight line and an off question. Okay, but for the most part, we're thinking effective interest. Okay, all right, good, not too bad. Now you come over and you just take a look, and I was sort of calling out those journal entries out of my head here a minute ago. There's the entry when you issue the bond, right? Then what? Then when you recognize the interest expense, multiplying the face times that market rate of interest, difference between that and the cash, which is always $50,000, goes to the amortization of the premium. Okay, and then after you've done that, after you've amortized the premium, say at the end of the first year, and notice guys, they just went ahead and calculated the interest expense here by taking the two interest expense entries and adding them together for the full year. Okay, and then they just went ahead and took off of the $1,081,109 the premium amortization for at June 30th, at December 30th. That gave me the new carrying amount of the premium and thus the new carrying amount of the bond. And we've already talked about how premium amortization brings the carrying value of that bond down from period to period. Okay, all right, good. Discount amortization, guys, same mechanics, different numbers, right? The carrying value right after we issue the bond is $926,399. That does not change. The issue price of the bond is not affected by whether or not we use the straight line or the effective interest method. Okay, so that $926,399 times now the market rate of interest, and I should have reminded you on the premium slide, but just remember, when you calculate the market rate of interest, they usually call out interest rates on an annual basis, right? 8%, 12%, 10%, those are the annual rates. But if you have a semi-annual bond, you have to cut that in two, right? So 12% divided by 2, 6%, 8% divided by 2, 4%. The semi-annual rate is 6%. We multiply that, gives me the interest expense, right? Okay. Compare that to my buddy 50,000, will not change. Okay, difference is my now discount amortization. Discount amortization does what? Gets added to the previous carrying value. So 926, the initial carrying value, plus my discount amortization, that gets added to the carrying amount, gives me the new carrying amount times 6%, and so on, guys. So it's almost the same thing. How you calculate the interest expense is exactly the same. The cash is not going to change. It's what do you do with the amortization. If it's premium amortization, you subtract it from the previous carrying value, as we saw. If it's discount amortization, as we're looking at here, you add that to the previous carrying value as that carrying value increases period after period. Okay? All right, and you see the journal entries here. Okay, the only difference is now, of course, we're amortizing the discount from what we saw in the previous slide. And then again, you would take the two discount amortizations here, and those two discount amortizations would come off of the discount. Of course, it started out at that 73,600. Here they're calling it 601 for some reason, 605, whatever. I'm not going to worry about $4, okay? But whatever that initial amortization was, then as that gets amortized down, the carrying value of the bond comes up. You could, let's try that. Let's play with that. You could take what? You could take this 926,399, the initial carrying amount of that bond, and you could simply add those two discount amortizations. Where's my number now? 5584, all right, plus 5919, all right, and let's go ahead and add those. Okay, so we've got, anywhere in this world is my calculator. Okay, 926,399 plus 5584 plus 5919. Isn't this exciting? Okay, gives me 937,902. And of course it does, right? Okay, because we've amortized that off the premium. Premium is subtracted from the carrying amount, so you make that number smaller. From the face amount, make that number smaller. The carrying amount will go up. Okay, and that's what you see there. All right. Okay. On your exam, you'll have plenty of time to figure out the carrying value because they give you, good ample time to calculate these. If you were taking something like the CPA exam, a calculation like this would be, imperative for you to have down because they don't give you nearly as much time with. They give you like 2 minutes per question or something, or 1.5 minutes per question. Okay. Okay, good. So let's just take a quick look at a couple more things, and then I'm going to go ahead and ask you to start to take a good look at your practice midterm on this, okay? But when you take a look here, we're talking about what happens if the bond is issued in between interest payment dates. So right now, we've been sitting there and we've been saying, well, okay, the bond was issued January 1st. And that's, pretty straightforward. But bonds, people don't just wake up New Year's Day and go, let me go buy a bond. Okay, what happens? People decide they retire in April, and they decide they're going to take some of their retirement money and buy a bond or something. Meanwhile, the bond pays interest in January and in June. So what happens? You're not going to be able to pay that person the full 6 months of interest because they didn't buy the bond until what? January, February, March. If they bought it April 1st, 3 months have already gone by. And some people may buy the bond in February. So we have all these different dates as to when people buy bonds. And it would create an accounting nightmare for the issuer of that bond, the company borrowing the money, if they had to sit there and cut an interest check to this one for $50,000, but for this one they have to cut a check of $33,000, for that person over there $12,000, it would make it nearly impossible to sit there and execute that sort of an accounting function. And so what the company does is they say, I know, if you buy the bond in between interest payment dates, you're going to have to pay me any interest that is accrued since the last interest payment date to the date that you're purchasing the bond. You give me that cash, I hold that cash, and then when the interest payment date comes, I pay everybody, say in our little example for this bond, $50,000, so that I just pay everybody the same amount. Now that $50,000 is going to be what? Partially a return of the cash that you let me hold for, say, those 3 months if you bought the bond on April 1st, and then interest expense for the back 3 months of that 6-month period. Okay, so let's go ahead and take a look at this bond. We've got the discount bond. That's that same bond that we've been working with. It's the 10% bond. Again, remember, guys, all bonds don't have 10%, and all bonds aren't face of a million. This is just this example, okay? And so what happens? They ask us in this question, well, how much cash are you going to get? Well, you know from our previous discussion already, this bond, which has a 12% interest rate, 6% semi-annually, 5 years, 10% face, would go ahead and have an issue amount of $926,395. But the other amount of cash we would collect on the issuance is not just the issue price, but also the amount of interest that is accrued. And in this example, it was April 1st, okay, that they went ahead and sold that bond, issued that bond. And so we've had what? We've had interest that accrued for January, February, and March, okay? So for the January, February, March interest, okay, we're going to collect that as well. The person says, wait a minute, why do I have to pay the interest for the time that I didn't hold, huh? They're giving us that money so we can hold it. They'll accrue now, what, April, May, June, the next 3 months, they'll earn that interest. We'll pay them, what, $50,000, because we want to pay everybody $50,000 on our interest payment dates, okay? So the total cash you get is what? $951. That's the $926,399 plus the 3 months, the January, February, March interest that you collected, okay? The discount is the same as we saw for the bond that was issued January 1st. The face, I highlighted the wrong thing. The face of the bond is the same, okay? What's happened now is the cash has gone up, and we're going to go ahead and we're going to credit interest payable here, okay? Don't worry about interest expense. This example, I don't like this part of the example because they're trying to show you how you might do a reversing journal entry at this point. I don't want to get into that. So you would debit interest payable. You're going to give them that money back. That's the January, February, March interest that they're giving you at this point, but you're going to have to give it back to them. So that's a payable. That's a liability, right? And then when June 30th comes, isn't this cool? You only have to pay, you pay everybody the $50,000, okay? And you would debit bond interest, and let's go ahead and make this bond interest expense, I guess, $25,000. Now that's $25,000 for what? That's April, May, June, right? Okay, that's for all of April, all of May, all of June. And then I got to squeeze in here somewhere. You would also debit bond interest payable, $25,000. That's $25,000. Let me get rid of that line. Isn't this exciting? See if I can. I'm like a surgeon with this thing, right? Bond interest payable, $25,000. Okay, and that's the, I'll write it over here. Excuse me, guys. That's the interest for January, February, March. In other words, you're doing what? You're liquidating this liability that you'd set up here. Okay? All right, good. That's not too bad either. Okay? The last thing I really want to get into, well, there's one more subject here, but the one thing I want to get into here is if the interest payment date falls into that next year, you still have to accrue the interest expense at year end. Okay, so in this example, what happens, we have a 5-year bond. Interest is payable July 1st and January 1st. So when we go ahead and we come to the end of the year, we would have to amortize the interest expense for the period that won't be paid until January 1st of the next year. So they go ahead here and they just calculate the interest expense just like we would if we were paying the interest on that date. We still credit the discount. The only thing that's changed here is instead of crediting cash, you have to credit interest payable, because you won't be making that interest payment until, in this example, January 1st of the next year. Okay, good. So let's go ahead and let's just take a look at a couple questions I stuck in there. Okay, I borrowed this from some other material because I think that, excuse me guys, I'm going to go ahead and pause here at this point. I think I can discard some of these. I'm going to pause here for 1 second, guys. I'll be back. Take a quick break because I got to clear my throat. I'm sorry. Okay, hang on 1 second. Okay, guys, we're back. Sorry about that. Maybe that's God trying to tell me to wrap this thing up and shut up. Okay, so let's go ahead, right? And let's finish up these last couple of things. So these couple of slides I put in here because I know that accrued interest thing is a little hard to follow. So I just want to give you some extra batting practice with that here. And then we're also going to calculate the interest payable part of that too, since we kind of just had a couple things there and we didn't say a lot. And then you'll see some more stuff in your practice midterm. Okay, all right, so let's go ahead. So what happens? We're sitting here and they tell us that on January 1st, year one, Eagle Corp issued 600 of its 10% $1,000 bonds at 99 plus accrued interest. The bonds are dated April 1st. Okay, now you stop right there and you say, well, wait a minute. If these bonds pay interest on July 1st, okay, and they are dated April 1st, okay, we have not issued these bonds on their the date that they're stated for what they're dated, and that can happen, right? The bond's dated January, you don't issue it till April, whatever, okay? In this case, they issue these on April. They mature in April, and interest is payable. Here we go, April 1st and October 1st, okay? So they're sitting there and saying, well, wait a minute. Your last interest payment date was what? Was April. And so what's happened is what? May and June have gone by since your last interest payment date. So we say, what amount should we receive upon the bond issuance? Okay, so our last interest payment date was what? Was April 1st. So we've had all of May, all of June go by on this. Okay, so we sit here and we say, well, we've got a $1,000 bond. Okay, $1,000 bond, and all of April, all of May, all of June, 3 months. Why I forgot May? May is my birthday month. I don't know why I forgot May. Hello. Okay, 3 months. The last interest payment date was April 1st. So now all of April, all of May, hello May, and all of June have gone by. 3 months have gone by, John, not 2 months. Okay, because they issued July 1st. All of April, they paid interest on April. Okay, that would have covered the period, the 6-month period between the last interest payment to October 1st and April 1st. Now we have to accrue interest for April, May, June has gone by, and then they issued it on July 1st. Okay, so it's $1,000 each bond. Okay, they issue 600 bonds. okay? And they issue it at 99. Now let me explain what that means, because we're going to be looking at that some more here in a second. Well, if you take 600 bonds times $1,000 each bond, right, you should have got 600,000. But if you issue it at 99, okay, 100 would be if you issued it for its face. You come under 100%, 0.99, then that means you issued it at a discount, okay? So you would take that 600 times 0.99, that's going to give you 594,000. Now, I know I'm going to get that because they issued it 99, but I also have to collect this interest that is accrued for what? For now, all of April, all of May, all of June, for those 3 months. Okay, so I sit there and I would take this 600,000. It's a 10% bond times 0.10, okay? But then I'm going to multiply that by what? By the fraction of the year that's gone by, and it's what? April, May, June, times 3/12. Okay, so when I go ahead and I do that math now, 600,000 times 0.1, right? And it's going to be what? Not times, times 3/12, okay, times 3 divided by 12 gives me 15,000. That's the interest that is accrued for that 3-month period, April, May, June. So I add that 15,000 because they got to collect the interest for that period plus the 594,000 gives me 609,000. And of course, in typical fashion, I don't have anywhere to write the answer. 609,000. Okay? All right, good. Not too bad. These get to be kind of fun after you work with them for a while, right? Okay. All right, good. Let's take a look at this next one. And they want me to figure out what's the amount of accrued interest payable. So January 1st, year 2, we issued 300,000. Maturity value, 12% bond for 300,000 cash. Okay, good. Don't have to deal with any premium or discount here. They issued this bond at face. Okay, the bonds are dated, right? 300,000, you get 300,000 cash, you issue them at face. The bonds are dated dated December 31st, year 1, and mature on December 31st, year 11. Interest will be paid semi-annually on June 30th and December 31st. What amount of accrued interest payable should we recognize at September 30th, year 2? Okay, so what's happened? Well, the bonds pay interest on June 30th and December 31st. So we would have paid interest on June 30th, right? And then what happens? Then we've got all of July, sometimes the hard part for me these days is remembering the calendar, right? All of July, all of August, all of September. We've got 3 months of interest that is accrued up to September 30th, when apparently they're preparing their balance sheet and want to figure out the interest payable. So we take that 300,000, okay? We pick up the interest rate, 12%, and we multiply that by what? By the 3/12. So make sure I got my dates right. Yeah, June 30th, July, August, September, we've got 3 months. Okay, so again, do the math on that. Okay, 300,000. When I do these, I take the 300,000 times the 0.12. Okay, that gives me that number. I hit equals, and then I multiply that times 3. I hit equal, and I divide by 12. You may have a fancier way of doing it. That's okay. I get 9,000 here. Okay. All right. Good. That's for those 3 months. Okay. Let's go ahead and let's wrap this thing up. Talking about extinguishment of debt. What happens? Well, look, let's say I issue the bonds, and you see some of these really high interest rates in some of these examples. And let's say I issue the bonds, and the bonds are 6%. And then, you know, we have the situation kind of like how we have now, where interest rates are plummeting, right? And so you sit there and you say, wow, I'm sitting here and I'm paying 6-7% interest, whatever, on this bond, and the interest rates are lower. What would you do in that situation? You're a company. You're the CFO now, CEO of this company, which, by the way, keep going the way you're going, finishing your degree. I recommend getting that CPA and that kind of stuff. You're going to find yourself sitting in the CFO, CEO seat, okay? Because most people are afraid of this stuff. They don't want to go near all this blah, 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 blah of sophisticated and, you know, difficult to got to stick your mind to the paper type of homework, right? Okay, so anyway, you're sitting there and saying, well, gee, you know, interest rates are a lot lower and I'm stuck paying this high interest bond. What should I do? Well, you do something very similar to what you would do if you were having your home financed. You would sit there and say, wow, when I bought this house 3 years ago, you know, the 6% rate was pretty good. Now interest rates, I saw something advertised the other day, 1% interest. Wow, well, I should refinance. Well, that's what you would do with the bond too. You would call the bond, pay off the bond, and if you still need cash to finish up your project or something, reissue bonds at a lower interest rate, right? Okay. So what we're going to see is when you call that old bond, when you take that probably high interest bond off the market, when you call that, what would be the gain or loss that would result from calling that bond before its maturity? Okay. So 2 steps to that. You got to figure out what's the cash that you're going to have to pay to call that. What's the carrying amount? I guess it's 3 steps. What's the carrying amount of that bond? And then the 3rd step would be the answer, which is to calculate the gain or loss. Okay? All right, so let's just take a look. And we have this bond, and it's an $800,000 bond. They want to call it, so they call it at 101. Well, now here's one where this bond was being carried at more than face because we went over 100%, right? So 1.01 is a little over 100%, right? If it was 1, it would be what? 100% over 1, more than face, less than 1, like that other one we looked at, 0.99 a minute ago. That's less than face. Okay, so 800,000 times 1.01 gives me this 808,000. Okay, that's the cash. Let's put that there. Let's just put cash that they're going to have to pay to call this bond. Okay, now the carrying amount of the bond, which is what we're calculating right here, is going to be the face. Okay, the face plus the unamortized premium, or less the unamortized discount, which is what we have here. Okay, and they tell me that the unamortized discount right here is 24,000. Okay, so you come over, I don't know about all this calculation. Look, they just gave it to me, 24,000. Okay, so I go ahead and I pick up that unamortized discount. I subtract it from the carrying amount of the bond, and that gives me now, since I had to pay 808 to retire a debt of 776, that's a loss of 32,000. Think of it this way, guys. Go back to the refinancing your house example. Let's say somebody told you, hey, you still owe $776,000 on your house, but I'll let you pay it off for $808,000. You'd say, what am I, a loser? I'm not going to take that loss. I only have to pay $776,000 to pay this off. Why would I pay you $808? Now, in the case of the bond, they're doing it because what? They want to get those bonds off of the market so they can sit there and now pay a lower interest rate. Okay, but you could have a gain if you're calling that bond as well. It doesn't have to be a loss. If the amount that you're paying is less than the carrying amount of the bond, then you would have a gain. Okay, all right, good. So come over And let's just take a look here at the journal entry for that. And they go ahead and they, of course, going to get the bond payable off the books. If you take the bond payable, got to get rid of that discount. Remember, the discount is a debit until you amortize it all the way down, or here you're getting rid of it, so you credit it. Of course, you have to credit the cash, and then the difference in this example was a loss, but it could be a gain. Okay, guys, good work. I know that's kind of a long discussion. Hopefully you got some tips as how to go through some of this stuff. And what we're going to look at next video is going to be the practice midterm for chapter 14.